Good morning, multifamily investor nation. I am Danny Randazzo, one of the managing partners with PassiveInvesting.com. I am joined here by Whit McCarthy, who is the co-founder and CEO of Consistent Capital. We're going to get into all of that good stuff as soon as we get started. We're going to give it probably just another 30-40 seconds or so for everyone to join us. While we're getting started, I always like to know where you are joining us from. So in the chat box, go ahead and give a shout out what country or city and state you are joining from. And then we'll get into the topic of conversation today, all about the lending environment. As always, these webinars that we do are for you guys listening and joining us. So use the chat box, use the Q&A box. I'm going to do my best to keep up with both and ask any questions that y'all have. So we will probably have a little discussion here back and forth between Whit and myself for maybe 15-20 minutes or so, and then we'll take any questions that may have come in towards the end of that time frame, and then we will wrap things up. So let's go ahead and get started. The kind of public service announcement for today, if you are interested in multifamily apartment syndication, get our copy of the book from Amazon. There's a link here. Just go to multifamilyinvestornation.com. Check out that book. And then if you're interested in what we do at passiveinvesting.com, just go to our website, check out our offerings and kind of our deal history. And if you are interested in joining us as a passive investor, go ahead and join the club and do that. So without further ado, there's a couple of links in the chat box for everyone there. And then I see a couple people in here are joining from some locations. Washington, D.C. is in the house as well. With that being said, Whit, welcome to the Multi-Family Investor Nation webinar. We do these every Tuesday of the first of the month. And next week it'll be the following after the 4th of July. So Whit, it's great to have you on. Give us a little bit of background about who you are, kind of what you enjoy doing, and give us a little bit of your expertise as a lender, just to kind of set the context of why you're an expert and why folks should really be listening to you.
Sure. And thank you for having me on today. Really appreciate it. I've been looking forward to this for a long time. Whit McCarthy, CEO of Consistent Capital. I am based out of Charleston, South Carolina. I moved here just under 3 years ago with my wife, 2 kids, 1 kid at the time, had another one since, 2 dogs. And we are very happily planted over here in Charleston. We had moved from Los Angeles, and in my off time when I'm not, being a dad to 2 young kids, it's, playing golf, and I like to fly fish and travel and go enjoy all of the restaurants that Charleston has to offer. So as far as my work background and lending experience, when I was in Los Angeles, I lived there for about 11 years. And in 2014, I was fortunate enough to be on the ground floor of an organization by the name of Civic Financial Services. Civic at the time was just an upstart with 3 of us working out of a conference room, and we were built out inside of a larger organization of real estate companies. But ultimately, we were determined to build a business purpose lending platform. So known as hard money more at the time, hard money lending, private money lending, if you will. We were really on the forefront at Civic Financial Services with institutionalizing the space, where traditional hard money structures, similar to what Rehab Wallet offers with the debt fund model through the PassiveInvesting.com platform, we were interfacing with institutional counterparties, big Wall Street firms, investment banks, REITs, insurance funds, where we would ultimately fund loans and sell them to institutional counterparties on the back end looking for yield. So this was really, at 2014, it was a very new thing to the institutional capital markets. And so we built that platform up from, again, 3 of us in a conference room to at the end of its reign was 450 full-time employees. Over the course of that business, we had originated just under $10 billion of business purpose loans. We focus primarily on residential fix and flip, bridge lending, transition into more DSCR loans, debt service coverage ratio loans for residential rental properties, 1 to 4 unit, and then up to, a comfortable level of, 5 to 9 unit some odd properties. And so we built that business up over a long time. And in our final year of 2022, we had originated just over $3 billion, which is an incredible achievement within the industry. Only one of very few people who'd ever done that. And throughout the course of our life cycle, we occupied the number 2 spot, number 1, number 2, depending on the month, for overall originations and production. So it was a great run, great ride. We were acquired by a bank in 2021. That was a great event for all of us, but ultimately it was a regional bank and tied up within the regional banking run associated with SVB. And we kind of got caught in the crosshairs, unfortunately, and wound down that business. And ultimately I spun out very quickly thereafter and very happily launched Consistent Capital. Doing a little bit different, same general kind of product overview, but we're more focused within the Southeast Midwest of working with the best real estate investors and providing capital needs to them for all their debt solutions.
Wonderful. Yeah, I know it's been quite the journey for you. I feel like there's such a depth of experience in originating billions of dollars in loans, to working under a institutional kind of bank formal structure, making sure that all of the boxes are checked before a loan is closed at the closing table. And then, getting into the new Consistent Capital venture where it's a little bit more tailored to be investor friendly. And, I know from my experience growing up as an investor, the debt component is always one of the hardest challenges, right? You go to the local bank and you're going to get 10 no's before you get 1 yes, or you're going to be bombarded with requests for 18 years worth of tax returns and how much in deposits can you give us? And then we might start to say yes. And so, catch us up on kind of what your take is on the current debt and lending environment. Obviously, we've all kind of ridden through the challenges and the rise in rates over the last 18 months, but kind of talk to us about like where we are today and what investors can probably expect for the couple of months to come.
Loaded question because it's such a moving target right now. But yeah, I mean, I think just to clarify, we only offer investor loans. I have never originated a loan for a consumer, right? Someone who's ultimately looking to acquire a property to live in as a second home. We are truly an investor lender focused on that. And you're right. I mean, when you get tied up within a bank structure where there's so much regulatory oversight, there's so much red tape, it's hard to stay within that lane of being an efficient lender, right? Because you have to jump over additional hurdles, request additional documents, go through different processes that are not market, because we are effective in the business purpose lending space because we can operate and provide leverage and speed to investors in the marketplace to be able to close, refinance their investment properties. So, the market right now is a little tricky, as you know, right? Interest rates have climbed steadily and have really stayed at a leveled off point. I mean, a little bit of fluctuation up and down, but what's really interesting, like the conventional rates right now, the delta between a conventional loan and what the loans we offer, which are truly just business purpose loans, it has never been tighter, right? So usually there's a much wider gap between what a normal homeowner can go and get for their primary residence versus what you can get for investment property. It's really, really tight right now because I think the capital markets are now fully awake and aware of the value within these loans, right? This paper that they're ultimately purchasing and they're holding on their books, it generates great yield, but also it is very, very low risk and low risk because ultimately you're not at a 97 or 90 8 and a half 97 and a half LTV, right, on an FHA loan. You are most cases worst case 80% LTV. Most situations are 75 or less. So there's a much wider spread. A lot of people think being in the business purpose or hard money lending world that you're dealing with people who can't get conventional loans, and there's some truth to that in some ways because so many people we work with are really active real estate investors that have crazy tax returns. As you know, Danny, like your tax return must be 12 encyclopedias high, right, with everything that you got going on in this world. So it's we cater to the people who just are very bankable, right? Plenty of cash, great credit. Our average credit score that we write loans for is, I think, 742 as of the last 6 months. So it's very qualified borrowers, but it's an interesting time in the marketplace. I think what to expect over the next couple months still remains to be seen. I think there's this hope that we should see some sort of rate reduction. We have seen the 10-year treasury drop a little bit over the past week, 2 weeks. Again, it bounces up and down every single day, but I think last I checked today we were at a 4.36 and a few weeks ago we were at 4.65. So that fluctuation.
Last night when I checked, we were at 440, so it went down 4 basis points this morning.
Yep. And
Holy cow!
That's
what
good.
a day!
That's good for all us.
It is.
The lending world, these mortgages, especially the 30-year loans that are written for rental purposes, DSCR loans, whether it be for a single family, a duplex, or a 9-10 unit, multifamily property, they're all tied to the 10-year treasury. That's the kind of the benchmark and barometer for at which rates will fluctuate, at least in our world. So yeah, it's hard to say, but I do hope and believe that we should see some sort of loosening. I think we'll see the markets open up a little bit, but I think investors should realize to an extent that this is probably not far off from the new normal for a while, right? I think the days of a 4%, 30-year DSCR loan, I think are gone. I don't think those are coming back. I think we will see some loosening and a little bit better pricing going forward, but not to the extent that we were at.
Got it. I want to go back in a second and unpack a couple things, but one question, are you still seeing good deals come through today?
We are. Yeah. So I think being that we focus on, I would say our two bread and butter products right now are ground up construction. And that has been a great product for us because a lot of people are doing the build for rent model right now. I think the build for rent is great. Spec build development, depending on the market, it can still be very strong. And so we're seeing a good amount of those loans and those perform very, very well, right? As long as you're working with the right sponsors that have the experience and know how to operate. And then DSCR loans are still very much in the market. And so whether that be, again, for an 8-unit multifamily property or a single family, and whether it's a single asset or a portfolio of loans.
Income generating investment real estate, predominantly in a habitable investment property, be it a single family house or a multi-unit building.
Correct. And to clarify, the DSCR is debt service coverage ratio loan. Just to clarify, it's for essentially just we're underwriting to the cash flow of the property.
Yeah.
I mean, that's the most important thing, right? And it's kind of a binary type transaction. It works or it doesn't. And there are levers you can pull on. And the lever that we've had to pull on most recently is you have to pull down the leverage a little bit, right? We're not doing 80% cash outs, right, on investment properties anymore. I think based off of where rates are at right now, it requires certain situations where we're bringing down leverage a little bit to be able to get these into a cash flow positive position. But, we've seen such an incredible run within this market, and a lot of people got adjustable rate mortgage products over the last 5 years or so that are now starting to adjust, and they need to make additional moves, additional plays within their portfolio for refis. But we're still seeing a lot of really savvy and active investors purchasing. And I think specifically on the residential side, kind of true. And I know we're talking in the Multifamily Investor Nation group, but the residential side, I think, will remain very strong. And I think we've instructed and advise our clients, like, if you can find the deals right now and make them work within the current rates, I would buy. And then there's always that opportunity to refi as soon as rates do drop. And, I think you date the rate, you marry the property. So I think you date the current rate and make sure that it's comfortable and you have your cash flow positive position. But get through this other side of whatever it might be, and effectively
Yeah,
in this
12,
last year
24
too.
months, maybe
Yeah,
that rate comes down by a point, point and a half. Maybe we get lucky and it's 2 points down.
yep.
Who knows?
For every 1% drop in interest rates, there's an additional 5 million buyers, people looking to come in and purchase that inventory in the marketplace. So I think as you see rates drop, you will see more activity obviously coming in. People get the ability to purchase again, right? A lot of people get priced out right now based on DTI and income levels and can't qualify for the current loans. But
Yeah,
it's going to be interesting when you see those rates drop. I think prices will continue to just be very, very strong and increase again because there's just going to be more activity.
that's right. Yeah, I agree with that. So going back to what you said a few minutes ago about there's specifically very little delta between what a traditional bank is offering, let's just say a second mortgage or an investment mortgage that a person can go and get versus the rates that the investment friendly, or excuse me, investor friendly lender can provide. I think, banks are probably around 8 or 9% interest rates right now, probably around 70% LTV. They're probably doing 5-year terms, and that's probably the best deal you're going to get from a bank for an investment property today. Probably with a lot of deposits too. So that being said, are investor friendly lenders in that 8-ish% range today?
We're inside of that. So I can tell you that we and other, business purpose lenders in the space right now, we are effectively writing loans inside of what banks are writing on investment
Wow.
properties. That delta on rates is actually the rates that we're able to offer versus what a traditional owner occupied borrower can get on a loan. It's tighter than it's ever been. And so we're seeing deals from borrowers who have always worked with their banks, right? Have never run into capacity issues, great relationships with banks that are now looking elsewhere for more business purpose, investor focused lenders, because way less of a process, right? Way less documentation, so much easier. We don't report to credit bureaus, so it doesn't negatively affect their DTI to go and borrow conventionally in the future as well. These are all written and provided to LLCs or corporations, right? They're given to businesses, so it doesn't
Yeah,
affect
so
them
again, an
on a personal
investor
level.
friendly product. Got it.
Exactly. Yep.
What should a typical investor borrower expect from a process to either get a new loan today or refi an existing loan?
Mm-hmm. And I'll speak from a DSCR perspective, kind of the cash flow driven loan that we're providing. So, I mean, the process is simple. I mean, we're closing deals in 3 weeks, and so we say 21 days is kind of the target, as long as we're provided what we need from the customer. And what we need from that customer is very simple. It's a very short form application. We need an understanding of the property, so we do an appraisal, right? And that becomes an important part of the underwrite and understanding the value, and then ultimately the cash flow potential if it's vacant, or getting the lease agreements if it is a leased property. So, and then the underwriting process is very simple and smooth, as so long as, again, we're provided everything that we need, and we don't request any income docs from personal income docs, obviously property related income, but we don't request any income docs, tax returns, anything like that. It's just bank statements to validate and verify some liquidity and ensure that they have some additional reserves, just to give an extra layer of comfortability to the lender. Make sure that, hey, if that tenant were to leave tomorrow, this person's not going to go into default right away. They have some cushion in there to be able to support payments for that period of time. So that process of intake is very simple. You get the appraisal ordered. You do run credit, but we don't report to the credit bureaus. And then, yeah, once we get the appraisal back, we get the title work, we get the insurance, we'll complete our final underwrite, which just confirms, yes, this does meet the DSCR requirements. It is cash flow positive to the point that we need it to be. And typically in some situations, we can just get down to a 1.0, which just means we need to make sure that the principal and interest payment plus your taxes and insurance is not greater than the rental income that you're receiving. So I always like to structure deals for our customers with a greater spread in there than just a break even, right? We're in the business of investing in real estate for cash flow,
there's some unknowns that are going to
depreciation.
happen. Yeah.
Of course. So, we like to structure it to about a 1.1, but we can go as low as 1.0 in certain situations. And yeah, again, we're very limited on the documents, and the process is so much simpler than what you're going to expect from a bank, which is going to require all your income docs, your PFS, your K1s for every single entity that you've been a part of ever, right? Your firstborn. And we don't want that. We just want to be able to get the documents that are necessary for our transaction, move it through.
Beautiful. Let me pause and just, if anybody has questions here, feel free to use the chat box or the Q&A box. I'm going to do my best to monitor both of them while we continue our discussion. So if you do have any questions, feel free to pop them in the chat box or the Q&A box, and we'll get to those. So, one important question, putting your investor hat on for a moment, in today's environment, what sorts of deals would you be looking for, or what sorts of deals have some customers presented that you have seen to be very appealing? Is it a particular type? Is it a particular location? Is it a certain economic indicator that you're looking for, that it's like, oh wow, this deal is really appealing, and it would be great if more people had similar deals to it?
Yeah, I think some of the more appealing deals that we're seeing right now are the people have done a great job of aggregating rental properties over a long period of time, right? And so we have the ability to do large cross collateralizations and portfolio
So if you
loans.
have bought a single family property, one a year for the last 10, and you have 10 properties today, and you've built up a ton of equity, they rent really well, and you're able to kind of roll those up and do a portfolio-wide refi based on the income that's generated from all 10, and kind of roll those up, and it gives people equity in their pocket because they're essentially executing a cash out refi to then go and buy some more deals, which I think, to your point earlier, there's always good opportunities in up markets and in down markets. I would say we're in a down market or a challenging time right now. So you might have to work a little bit harder or twice as hard to find one deal. But if you have the cash in your pocket and you find the great deal, like now could be a really good time to buy. And like you said, you date the rate. So just be in it for the next 12, 24 months. When it comes down, then you do it. So
exactly. That cash out refi in the portfolio, because you have properties that have different levels of different DSCR levels. And so within a portfolio, you can balance them out and come up with an ultimate loan amount that works for that situation. And the greatest part about investing in real estate is when you are able to execute on that cash out, that's tax-free money. The best money in the world is tax-free money. So get that money out, put it in your pocket, go have that as dry powder to go buy additional properties as you find them. And again, I think as long as you're using solid underwriting techniques and not over leveraging, and you're not getting out over your skis as far as your DSCR, and be realistic with your figures, then I think it's a great time to buy if you can find the deals.
Yeah, or I would probably venture to guess, if you bought a deal maybe 2021, maybe in 2022 if you bought it at a good discount,
Mhm.
or earlier than that, you're probably in a position today where those real estate values have gone up and you could be in a position to do a cash out refi and have some dry
Absolutely.
powder ready to buy.
There's of course a cost benefit analysis there, right? Because a lot of those loans are on the books at, 3, 4, 5%. And so I think you just need to understand kind of what is more valuable to you, right? Is it just maintaining your current equity position in that property, having a great single asset that's going to support you from a cash flow perspective? Or if you do refi that, you increase your payment by, 1.5x, and then you can still bear that, you can still support it, and you can take that cash and buy more. I'm always in the mindset, and I know you are, Danny, of you got to grow, 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 right? I mean, that's how you build scale, right? And you have the ability to kind of diversify across multiple properties as opposed to having it all locked up in one. So
Yeah.
I love that methodology and that play of being able to just constantly utilize the equity within your property. Use it as an ATM machine and pull that money out when it's appropriate to go buy more.
Yeah, I think, the other piece to your point earlier about, make sure that it cash flows today based on today's rates and it's a good deal today, is something, again, you just got to stick to your fundamentals.
Mhm.
And, we've done a good job of sticking to our fundamentals. I don't think we've bought a multifamily deal in the last year and a half. Um, and that's just because our institutional size deals um, didn't make sense with where
Yeah.
rates were at and where sellers wanted to sell at a certain cap rate and where buyers wanted to buy at a certain cap rate. There was just a big gap. And so um, we weren't in the market of buying things that weren't producing cash flow. So that was a challenge for us. But I do
Mhm.
think, from a general investor perspective, there's some great opportunities out there today where you can, roll up a portfolio of single families that you own and then go and buy commercial property or a 10 unit multifamily and let that go.
Yeah.
So let me get a question in here, and feel free, guys and gals out there. We'll probably go for the next few minutes as questions come in, and when we're done with those, we'll probably wrap things up. So, a question in here: what is a construction loan like, and what are the terms? And let's do it two ways. One, from a single family kind of ground up standalone deal, and then what would a kind of commercial construction loan be like
Mhm.
if you were trying to build a 50 unit or a 50 unit townhome development, a little bit larger of a scale. So let's go with
Yep.
the single family build, and then let's go with a 50 unit size.
Yep. And it is an important distinction, right? And I will say that I think there's two different worlds. There's the world of single family up to about 9 or 10 units, right? Really small balanced multifamily that we in a lot of ways are able to work that into more residential guidelines and programs, which I think is to everyone's benefit, right? So when you have the ability to operate in that capacity, you should. The larger multifamily, once you get 10 units plus, then you're dealing with the true CRE type product, and it's two very different worlds. Um, the ground up construction, new construction loans that we're offering right now for 1 to 9 some odd units, they are first we need to assess what the exit is, right? Is it a build to sell? Is it build to rent? Obviously, the underwrite is ultimately, it's the same, being that you need to make sure that it works at prevailing rates on the backside if they do
Oh,
intend to hold.
yeah.
Yeah. So rates, I can tell you it's a bit of a moving target as well, but rates are typically in the mid tens to mid 12s right now, right? And that's of course interest only and non-Dutch, meaning you're only paying interest on drawn funds. You're not paying interest on the entire amount of the loan from day one. So it's there is a little bit of a dislocation when you start talking about commercial, like true CRE, and more of the residential stuff. The residential stuff is pretty easy to work at an 85 some odd LTC, maybe even 90 in certain situations. So loan to cost on your construction. So inclusive of your total land plus build costs, soft and hard. That's about 85 or 90 LTC, which I think is great. And it's pretty aggressive for residential. When you start looking at commercial, right, when you start dealing in the CRE world, it is vastly different, right? The LTC is drastically pulled back. Rates will be typically a little bit less, and it's more tied to, an index such as SOFR or whatnot.
Yeah.
So
I would still see them around 10%
yeah,
rates. Maybe at most you're getting to like 60 loan to cost. More than likely, if the word bank is in the name of the institution, you're probably topping out at 50%.
yep.
And the borrower is putting in the first half of the cost, and then the bank kicks in the last bit of cost. So there's definitely some nuances to that larger commercial space. Lenders are super selective in that space right now as well. So it's
There's way
definitely
more no's than
challenging.
yeses in the
Yeah.
marketplace on the
And
CRE stuff.
my feedback to people is always like, hey, shop the deal around to multiple people or work with a great broker if you're kind of in that 5 million and up space. Things can be drastically different, so it's good to get several opinions. But
Agreed.
if you're in this, like you said, kind of small-ish 10 kind of units or under, there's some pretty competitive products out there. Just because there's a lot of institutional money, I think, in this investor friendly lender environment today.
Absolutely. Yeah, there's so much appetite in the institutional side for this paper, right? Whether it be the ground up, the DSCR, fix and flip or bridge. So it is an interesting time to see kind of that dislocation between the CRE markets and let's call this the residential type market right now, and just kind of what the desire and appetite is. So yeah, it's been good for us, being that that's been our focus, and we certainly have the connections inside of the true CRE world. It's just not something we have heavily focused on, considering just the climate right now.
Wonderful. Whit, thank you so much for joining us. If there are any last minute questions, feel free to ask those now. I will get to maybe one or two more if there are any. Otherwise, we will catch all of you next month on the webinar, multifamilyinvestornation.com, to register to join for next month's webinar. That information will be coming out very soon. Whit, as we close things out here with you, what is the best way for someone who may have that portfolio loan or be looking to refi an investment property today? What's the best way for them to get a hold of the Consistent Capital team?
Yeah, you're welcome to reach out to me, right? I'd love to talk with anyone inside of this group. So Whit at consistentcapital.com. We have a full team here ready to support. You're welcome to go to the website, consistentcapital.com as well. There's a button in the top right that says get started, and you can actually just submit a short form, just quick application that gives us enough information to get back to you with some general term structure and pricing. So self-service, or you're welcome to reach out. Happy to chat with anyone inside of this group.
Wonderful. Both of those links, Whit's email and consistentcapital.com, are in the chat box. Thank you everyone for joining us today. We will catch you next month on Tuesday. So enjoy the rest of June. I hope it's productive for you and you can go out and find a great opportunity to invest in. See you.
Thank you, Danny. Thank you, guys.